The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalized advice tailored to your specific situation.
The older you get, the more money you have. People that were 45 years and older were actually increasing their discretionary spending, whereas everyone below that was decreasing. And the reality is that right now, we are late in this economic cycle. While we may be in a weaker part of this economic cycle, it's going to take quite a lot before it becomes potentially alarming.
Hello, everyone, and welcome to another episode of The Wealth Guide, sponsored by Ryker Capital.
Unemployment has never been lower or in multi-decade lows. The point we like to make here is that as long as people have a job, you don't really have to worry too much. And in fact, yes, unemployment can start creeping higher, but again, just doing some rough math around Australia, for us to get back to the long-term average unemployment rate would have to see such a delta and such a swing from job creation to job losses that this is not something that can happen over a period of months, but may actually take years.
Very excited today, episode 2 with our very special guest, Mr. Nathan Lim, who is the Chief Investment Officer of Lonsec Holdings. Welcome, Nathan.
Hey, Tamara. Thanks for having me on the show again.
Also on the couch today, we have Principal and Senior Advisor, Mr. Ray Regmi. Hello, Ray.
G'day, Tamara.
And another Senior Advisor with Ryker Capital, Mr. Dean Dasuki. Hi, Dean. How are you?
Hi, Tamara.
As I said, this is our second episode that we've had Nathan Lim as a guest. Really encourage you to tie into and listen to the first episode. What we're talking about today is Nathan does a lot of work on, and let me read what you're producing and correct me if I'm wrong. This is the Portfolio Perspectives Insight. That's one. Is that right, Nathan?
Yeah.
I think we're going to dive into what the latest insights are from February, and I believe you're also on top of March as well. So we're going to dive into that today.
Yeah.
Really, as we were saying, we were preparing for the podcast, everybody really likes an excellent economic discussion, something that is relatable, something we can learn from. So we're really going to unpack that today. So really stay tuned, whether you are one of our referral partners or one of our clients or potential clients, really unpacking the insights and how they would affect you potentially in your business and you personally in some of your decisions is what we're after today. Now, Nathan, tell me, how often do you put together these insights and perspectives? What is the cadence and what are you trying to achieve with this cadence?
So the cadence is monthly. We're publishing these updates every month.
Yeah.
And the idea is that we want to basically give our clients a perspective on what we're thinking about. Now, it doesn't mean that we're trading or we're recommending changes to your portfolio every month. We just know that there's a core strategy and we're just trying to provide incremental updates. The reality is, if you were to do this quarterly, well, in the last 3 months, just think about what's happened just in the last 3 months. And then you think about, well, is that the right cadence? Is that the right amount of, the right frequency to make sure that people are informed? And I think that's really what we're trying to do with Portfolio Perspectives. So what you see is that every month there is a text version. So it's like 2 or 3 pages where it's very heavy on text, but it really goes into the minutia of what we're talking about. But then accompanying it is a PowerPoint presentation, and it's got lots of pictures. And basically it's the exact same text, but in picture format and a little bit of an explanation. So it helps people digest what we're trying to explain.
Now, I might put some context in again, particularly if you've just tuned into this episode. Relative to what you just described, Nathan, can you kind of give us a little bit more context of then when you say people, who are your clients? And financial advisors like Ray and Dean and Ryker Capital are your clients. So
that's right.
That's where the materials are mostly aimed towards as well?
Exactly. We describe ourselves as a B2B business, meaning that we're here to support other business owners in helping them achieve their objectives. Now, in the case of Ryker Capital, you guys are working with direct clients, helping them achieve their financial goals. What we as a firm entirely is help people like Ryker Capital, financial advisors, and arm them with information, with research and with solutions to help them match that with what their clients need.
Now, before we go into those key messages, because as I said, what we would really like to do as a team, we want to dive into each of those key messages from February and really have a great discussion and let the advisors kind of pick your brains, ask some questions relative to our referral partners. Before we do that, I wouldn't mind...
Tomorrow, let me just jump in there. We've actually just published the March update. So
are we going to go from March?
We can go from March. We can go from March.
Okay.
The good news is that, like I was saying, we're not trading every month. We're not seeing these changes. So from February to March, the themes that we've been talking about for several months now, they haven't changed, right? So what we have is the more recent numbers. So at least I can talk to some more current numbers.
I love data. I love data and context. So let's definitely do that. Maybe before, if I can just get your, yours, Lonsec's views on interest rates and inflation trajectory for the remainder of 2024. Everybody wants to understand that. What do you want to comment on that? Or how can you comment on that?
Well, the first thing I think is very important is context. You're lost if you don't know where you are, right? It seems like such a simple truism. And the reality is that right now, you have to remember we are late cycle. Right? We are late in this economic cycle, right? And so with that, I do deliberately want to cast a bit of conservatism over what's going on, right? That's the first thing. The second thing as well is that unlike the last 10, 15 years post the global financial crisis, we are seeing a much more desynchronized economic scenario than we have at any point post the GFC. If you cast your mind back to the last 10, 15 years, everyone had the same monetary settings, everyone had the same sort of economic outlook, everyone was going up for lack of it's a simple description. Now we look at where we are today. Japan has just gone into a recession.
Yeah.
Europe has just narrowly avoided a recession.
That's right.
The US is ticking along, and I don't see any sort of risk that Australia faces a recession. So there's extremes. There's more of a range of potential outcomes are out there right now. But again, why are we so definitive on this view that we are late cycle? The best indicator that we have for this, and again, this is a bit more US centric only because the US is still the largest economy in the world. Yeah. It still does sort of drive it has a big influence on macroeconomic activities globally. There's an indicator called the US LEI, or the US Leading Economic Indicators, right? And the LEI, this indicator goes back decades. And what usually happens is that just before a recession, the LEI will fall very sharply. Right. It's that's why it's called the leading indicators. It's giving you like the big red light. Something's wrong.
A canary in the coal mine.
Canary in the coal mine, right?
Yeah.
And so what you've seen is that now for the 19th month in a row, the year-over-year change has been negative. So this is what you would call the classic red light. There's something going on, right? And so for quite a few months now, the conference board, which is the group that actually puts out this indicator, have been warning the US is heading towards a recession. Even though this is the 19th negative reading, the conference board has now said, actually, we no longer see a risk of a recession, right? And so this dovetails nicely into Lonsec's view that we're heading for a soft landing. Right? What we mean by that is that while we are going late cycle, we're not envisioning something like the GFC, something like a hard landing, a very jarring dislocation in the economic environment. What we're looking at is something more like, right? A technical recession where you might briefly go below 0% up to maybe 0.5% growth. It's not catastrophic. It's not terribly exciting. It's a soft landing.
So this means from how it affects people's everyday lives, how businesses are functioning, how people are running their households, how people are investing. Is that what you're talking about? So technically we're in maybe a recession, but we're not acting that way. Is that what you're talking about? How it translates?
I don't believe that we are in a recession. Okay. I think what we are is in a slowdown. We're in a period of a lack of growth as opposed to like a crash.
Correct.
Right.
Okay.
And I think there's degrees. Yep. And I think that's what we're trying to sort of relay to our investors and to our clients is that, yes, you should be conservative, but it's not the end of the world conservative. Like, don't get your gun and beans and climb into a bunker, that sort of thing, right?
You'd have to dig the bunker first. Thank goodness that is the suggestion. Okay, no, that's a good kind of macro view. Yeah. Before we go into the key messages, any comments, guys, on
look, I think
how you're feeling with
we do sort of see that come out in the small business. I mean, like especially when we see the small businesses, they are struggling a little bit.
Yep.
Maybe maybe at the back end of the high interest rates, and sort of, the cash flow is pretty tight for them. Retail spending, we're sort of seeing that is a little bit tough at the same time. So pretty much what you're saying, we do sort of see that in the...
It's playing out in real life to what you're...
Very
is that
so.
With clients as well as business partners?
As a small business that we're seeing at the moment,
Yeah. Are you finding the same thing
I
as well?
find the same with a lot of clients, with the increase of rates at the moment now, a lot of people don't have much money for discretionary spending as they used to before.
So we're
and the
pulling
same with businesses.
we're pulling our belts in, but the thing is, the employment is still pretty good, so there's cash flow, right? So is that what you mean, Nathan? So if as long as
you guys are touching on 3 different things here.
Oh,
so
sorry.
You got rates. Let's unpack that. It's
That's
actually
why
really
we need
interesting
you here.
because this is where it gets really interesting, right? Because you've been talking about consumer behavior, you're talking about rates, you're talking about inflation. So again, let's take a step back. Let's unpack that, right?
Great.
I think the very first thing you got to be thinking about is what we're calling the 2-speed consumer phenomenon, right? It's absolutely true that people are doing it tough. But at the same time, it's also absolutely true that there are a bunch of people that are not doing it tough, and they're doing great, actually.
Right, okay.
So the ABS, the Australian Bureau of Statistics, they got this great survey where they've actually broken the country down into households. So if you think of Australia as a collection of households, they've broken those households into quintiles. So what that means is in 20% buckets. So 5 buckets, 20%, 20%, 20%.
Okay.
Right. And then they did some analysis, right? So it turns out the 2 top quintiles, so 40% of the population holds 64% of our collective debt, but they also control 63% of the collective gross income. So the group who are most at risk are also the same group that are most able to deal with that risk. So this is the point. Yes, you are seeing people struggle, but at the same time, you're not. And so you've got this really funny situation where you've got these 2 groups. This is why when you look at the stock market here in Australia, the consumer discretionary subsector of the ASX 300 has massively outperformed the ASX 300. Why would people buying discretionary items, and when I mean by discretionary items, I'm talking about things that you don't need to buy. You need to buy food, that's essentials, but you don't need to buy a new TV. No. You don't need to buy an LV purse. But how then, if we are late cycle, if we're in a waning economic environment, are people still spending up? And this is what we're talking about, how there's this 2-speed economy, there's this 2-speed consumer. In fact, we've got some really interesting data. The Commonwealth Bank, very recently, they had their financial results, and they also produced this really interesting chart whereby they break down their customer base by age group, right? Now, again, going back to those quintiles that I was talking about, it's also generally true that the older you get, the more money you have. And that kind of makes sense, right? When you're first starting out in your first job, you don't have a lot of savings. When you're nearing retirement, you've had many, many years of income, you've been saving, you've been building up assets. So that is another way of looking at this sort of 2-speed consumer. And what's very interesting is that in their cohorts, people that were 45 years and older were actually increasing their discretionary spending, whereas everyone below that was decreasing. So again, that has very interesting connotations about, if you're an investor, where you actually want to position yourself, because you cannot just simply say, oh, businesses are doing it tough, or, oh, everyone's buying their LV purse. You got to get more granular, right? So that's sort of the first thing I'd pick up is that you got to, and that dynamic, that 2-speed consumer, it's not just happening here, it's happening around the world. So again, this is where the value of active management and stock picking really comes into play.
Right.
Well, that makes sense too, because I bet, and I wouldn't mind, thank you very much for drilling into that. I wouldn't mind going to the advisors now too. So you must then see clients who are in both of those sectors, right?
And finally, Nathan was talking about this Commonwealth Bank data. We sort of see this older people population saving more and more and more. Perhaps they're up to their first property, second property, third property. So they're sort of adding more and more assets, where you see the sort of younger part of that generation below, they are sort of struggling with that sort of buying assets or buying a home or their first home or the second home. So you do sort of see that disparity quite a bit. So in the system, sometimes you go, is it really skewed system a little bit? Is it more sort of, geared towards helping people who are sort of already making a lot more money? You know what I mean?
Well, and then that kind of information coming from, Nathan, that kind of business, those insights, the CBA, et cetera, then it really lends itself to your point, the importance of, intergenerational types of scopes or views and how we deal with families potentially.
Yeah.
If you have that kind of data coming through in that reality.
That's right. Well, we do know that there's right now, as the boomers have all started to retire. I think the first cohort of baby boomers started to retire about 10 years ago.
Yeah.
That over the next 20 years, there's going to be a big transfer of that wealth that they accumulated, pass it down to the next generation. So this is coming, and it is something that a lot of families should start thinking about this. I have to admit, it's always hard to talk about money. Yeah. But it's so important because you actually kind of want to talk to mom and dad or your grandparents while sadly their capacity is still there.
Yeah.
You don't want to be having those hard conversations late in their life. I think it's very important that families should speak about those sort of dynamics earlier on. And so that way, while everyone is still calm and you've got time, and you can just very patiently nut out what are the concerns that everybody has and deal with them, as opposed to having to do it in a rush during a crisis.
Yeah.
Are you finding that too, Dean? Because I know that we were just talking lately, you were getting referred a lot of, I guess, clients who are maybe more on the younger side. And I'm assuming that you would have conversations where they would go, well, look, my parents want to, perhaps help me, with a property purchase, or, we're looking at this and that. So how do you kind of, to Nathan's point, you start kind of diving into those conversations and maybe even bringing in the older generations in the advice process? Are you?
Yeah, look, definitely. So the thing is, at the moment now, we see, given how expensive everything is at the moment now, the younger generation is finding a little bit more difficult to build assets. For example, in particular, the property side of things. So they are leaning onto their parents and things like that to actually help them and give them that step that they need and a little bit of push to help them to get across the line. So there's a lot of change that we've started to see. I know when I came to buy my first property, it was a lot easier than what it is at the moment now. There is definitely a big shift that we've seen.
But another part of the shift, to Dean's point I was going to mention, was we're seeing a lot of granny flat arrangements.
Yeah,
it is so funny. It's
so what does that mean exactly?
Basically, a granny flat arrangement is where you are helping out your parents, where you buy a house together, perhaps, and then what you're doing is you're buying a big chunk of land. Your mum and dad have got a granny flat at the back, and you've got a primary residence. You're both going in together with that sort of granny flat arrangement to go. They've got rights to live in that house up until their lifetime.
Okay, and that has, I'm assuming, tax, probably retirement planning, center link, all those types of things.
Absolutely. There's a variety of different implications that comes with it. So obviously when you're selling the property, depending on what assets you've got, there may potentially be capital gain tax. There might be settling implications because now you're selling the asset, and what does that mean for you from getting that government pension perspective, and not only to the mortgage situation. What does that mortgage look like? Usually most of the time is a mortgage relief. But yeah, there are a variety of different aspects that goes with it.
This is so intriguing to me. So we come out as economic data, the stuff that you live in, etc., and how that trickles down into the reality of how we apply that reality, right? You're going to the next stage now. We've kind of unpacked that first one that we brought up. What was the other one you're thinking of?
The other thing you should be thinking about is, yes, we are late cycle, and going back to the whole narrative around the soft landing, that it's not going to be bad, would be the way I describe it. And the indicator, or the thing that I look at, is employment, right? Okay. So whether you're in Australia or the US or Europe or Japan or even China, unemployment is either at all-time lows, like here in Australia, like the ABS has got data going back to the 1970s. Unemployment has never been lower, or in multi-decade lows, right? Yeah. And so the point we like to make here is that as long as people have a job, you don't really have to worry too much. And in fact, yes, unemployment can start creeping higher, but again, just doing some rough math around Australia, for us to get back to the long-term average unemployment rate would have to see such a delta and such a swing from job creation to job losses that this is not something that can happen over a period of months, but may actually take years, right? And so the point we're trying to make is that while we may be in a weaker part of this economic cycle, it's going to take quite a lot before it becomes potentially alarming, right? And so again, we're not seeing those alarm bells. We're not seeing mass layoffs. We're not seeing unemployment skyrocketing. In fact, we're still having net job ads, not going backwards. People are still adding jobs. So I think that's another very key element here, is that people are spending, right? There's a large cohort that's still
We're spending,
spending.
yep.
In aggregate, people still have their jobs, so that keeps a minimum level of spending. And then this then feeds into the next part, which is, okay, so what are all these people doing? What's all this fuel? I describe all this as fuel. What is it going into?
I was going to say, where's it pointing to? What
It's
is
going
okay.
to that the end result. What is the inflation going to look like? Because if they keep spending,
Exactly.
that just fuels more inflation.
Well, yeah.
So this is the thing, right? Is that so all this spending. So first of all, remember that the spending ultimately is a big component of the services economy, right? So a lot of people, you always hear headlines about how manufacturing is weak, exports are weak, but really we're a services economy, right? And as a services economy, household spending is actually the best indicator. So as long as household spending stays up, services stay up. And the best indicator of that, of course, is the PMIs, or the Purchasing Managers Index for the services sector. It's a very interesting indicator because it's very simple. If you have a reading above 50, it means that people, the surveyors collectively feel that conditions are getting better. If the number is below 50, it means it's getting worse. So it's a very, very easy indicator to look at.
Okay.
It is consistently sticking above 50. Right. In Australia, it's actually dipped below 50, but it's coming back up. But again, when you look at the average for China, the Eurozone, Japan, and the US, it is holding above 50. So the services economy, which is the majority of the global economy, is doing just fine.
Right.
Not great, right? But in the soft landing context that we've been thinking about.
That makes sense. So now we're talking, that ties into the cash flow. So maybe let's do the same thing that we did before. So having said that, so we've got unemployment is very, very low. So I'm assuming that you are seeing that as well, Dean and Ray. So you have clients being referred to you, or looking at clients. They are tightening their belts, but they still are having, by and large, cash flow. So therefore you are able to work with that.
Yeah. So there is a little bit of a cash flow, not a significantly lot. Again, like I said, depending on what life stage they're at.
Of course.
Obviously, for the early stage, life stage around 35 to 50, we are seeing a bit of a cash flow restriction there. Nothing but purely out of the mortgage strain more than anything else. But they've also sort of started to buckle down quite a bit, because now they're sort of getting into the habit of saving and sort of they mentally start to prepare that the interest rates are going to potentially stay there for at that rate for potentially longer time.
Right.
So they're starting to adjust their belts accordingly and sort of manage their cash flow accordingly. So they've had time to sort of get adjusted to it.
Well, and that's really good too, because again, as long as you have the cash flow, and then it's that discipline of, well, this is the reality I'm facing. And it's amazing how because we all run our own households as well, how you adjust to that, because because you still have the cash flow and you make the adjustments. And those are decisions which I think you do every day. And I might tie into your clients as well, because I know you, Dean, do a lot of work with clients around cash flow management, that readjustment sector, to make sure that they're still enjoying their everyday life, but getting ahead with investments as well. Are you finding that because I know you dive into that quite a bit with clients.
So clients at the moment now, I think given the whole rate rises and how things have changed, people are having to start to tighten their belts a bit. But it's a good thing for clients as well. And a lot of the time when I have a conversation with these clients, it's that now they've experienced these types of events, now they can understand the importance of planning and understand the importance of not just spending everything and only putting a little bit away. So for some clients, it's actually worked out really well, where they've actually now started to get a lot more discipline. But a lot of them aren't doing a lot of discretional spending that they used to previously.
No, and I think they sort of come back at the back end of COVID. Sorry, Gene, jump there. At the back of COVID, they already had savings.
Correct.
And when they started to sort of see these interest rate movements, they sort of automatically, it wasn't that hard for them to shift that mentality back into the COVID mode to go, I need to save this amount to get through this tough time.
Yeah.
So it was sort of programmed in a way that it sort of worked well in that situation. So that's why we're not sort of seeing massive delinquencies. I don't know, I imagine.
Yeah. Well, if you look at the CBA numbers again, the last time I looked at them, housing mortgage delinquencies were still at record lows. Right?
Yeah.
We haven't seen numbers like these in decades, right? So people are staying current, which is, again, another sign of why we believe that we're in a soft landing. Hard landing scenarios where you're going to start seeing delinquencies and defaults just skyrocketing. It's crickets there right now.
Well, and that was in the news a lot. It was, look out, there's going to be a whole bunch of delinquencies. But you're saying the data's not showing that.
Didn't happen. I think a lot of people were talking about the mortgage cliff, right?
They were.
And that was a real problem, right? We had a whole bunch of people that were going to have to refinance out of very low interest rate mortgages into higher interest rate mortgages because the RBA raised interest rates. It was the Reserve Bank of Australia raised interest rates. But then when the rubber hit the road, the crisis never manifested.
Yeah.
And to you guys' points, I think people realized that, hey, I got to be a little bit more responsible. Maybe they took that cash. Maybe they took some of their investments. Maybe they tightened their belt and they directed all of that to pay down their mortgage, right, and stay on top of their mortgage.
But I reckon it'd be very interesting to see if the inflation rate stays the way it is and the mortgage rate stays higher, how long until that delinquencies rate go up.
Well, actually, that's a really good segue into.
That's a good segue.
That's a good segue, right? Because it all comes back down to interest rates and inflation, right?
That's exactly right.
So here's something to think about. All right, so I got some numbers here.
Oh, excellent.
So
You
does
can't
anybody
prepare,
want?
Nathan.
Let's get into the numbers.
Anybody want to guess for the 12 months to December, how many permanent residents and overseas students entered Australia in the 12 months?
Ooh,
I think something around about.
I can say
170,000 or 190,000?
I think
Wasn't it
For
400,000?
the year. For the year.
Well,
right?
for the year,
For the
okay.
year.
I think
Not
it's
just for
closer
the
to.
month.
I think it's closer to
400,000,
4.
wasn't it?
Yeah.
400,000? You had 100? Okay, so
For the year, you
for the
mentioned.
year. For the year.
Oh,
So
okay.
there are.
I'm going to say about 600,000.
Okay, you guys are way off.
Help us, Nathan.
So permanent residents, 1.29 million.
Wow.
Wow.
Overseas student arrivals,
Yeah.
733. Okay.
Gosh, we were
Now
very
against
low.
that, we had 643 permanent and long-term departures. So these are people
Okay.
that perhaps Australians saying, you know what, I'm leaving the country for good.
I'm moving to
Fair enough.
Saskatchewan.
I'm moving to Saskatchewan. Right? And also you had a bunch of students go home, right? So you have to net that out.
course,
So you
yeah.
had 549,000 overseas students go home.
Okay.
Okay. But when you add all that up,
So what's the net?
that's a net increase of 834,000 people that are looking for long-term housing. That number is about 3% of the population of Australia.
I was going to
Okay.
say
That's a big
housing
number, yeah.
pressure.
So
Yeah.
does it surprise anybody that when you look at inflation, why rents are going up?
It does
Or
not
why people are buying
surprise, no.
furniture, right? And
Yeah.
so there's that one element, right? It's don't get me wrong, that dynamic of net migration or net inflow of people coming to Australia has been around for a long time, and it has underpinned approximately half to 1% of GDP growth in Australia for a very long time.
Yeah.
So that's always been there, but that's come back,
Yeah.
right?
It's come
during
since
COVID.
COVID.
During COVID,
Yeah.
it was negative. It was
Yeah.
net negative, but
Yeah.
then with COVID, that has all come back. So that pressure's come back into the system, right?
Of course.
And you think about when you look around the country, are we building enough houses fast
No,
enough?
absolutely
Well,
not.
that's what I wanted to
There's a
segue
housing
into because that
shortage.
makes
Yeah.
a big difference in investing in property, etc.
It does.
So
It does.
that hasn't quite. Oh yeah.
Park that for just
I
one second.
parked it.
Just park that for one
I
second.
wanna get
Because
to- I wanna get to it.
Yeah, we'll get to property.
Getting
But
too
so that's
excited.
well, that's
I'm
the
very
thing, right?
interested in that. Yeah.
So part one, right?
Yep.
We got lots of people looking for houses. So that's
Right.
inflationary.
Yep.
Part two, we know that wage growth last year was 4%. Why is 4% so important? Remember, the Reserve Bank of Australia, when they set interest rates, they're targeting to have inflation between 2 and 3%.
Correct.
Yeah.
So if you think about it mathematically, if things are going up 4, how can you get to 2? Right?
We
You
can't.
can't.
Yeah,
right?
wow.
So that's inflationary.
Yeah.
Wage pressure is inflationary. Now, I would argue that the Reserve Bank has got nothing to do with immigration policy and has got nothing to do with collective agreement bargaining, right?
Yeah.
So these are things that are outside the
Yeah.
remit or the purview of the Reserve Bank, which is why, so when they raise interest rates or move interest rates, it's like second, third, fourth order impacts. It's a very blunt tool to manage the economy. And now here's the last kicker, right? Stage 3 tax cuts.
Yeah.
They kick in July 1.
That's right.
They've been rejigged, fair enough. But based on, again, the data that were coming out of the ABS and the Australian Bureau of Statistics, you can make an assumption about how people will actually spend their tax cut. And so if you assume that those different cohorts, so remember those quintiles, if they keep spending the way that they've been spending, we estimate that on an annualized basis, this will inject $15 billion into the economy on an annualized basis. That's equivalent to 0.6% of GDP. Okay.
Jeez.
That is just first order impacts. And so what we're talking about is that, so remember, I'll get an extra couple $100 a month.
Yeah.
That, and I go spend it. That is where the first order impact. But that spend goes into a business or goes into someone else's wages who then spend it again. So when you take that first order impact of 0.6 and you apply a multiplier, you can see how stimulatory this potentially could be, right? So this is all very inflationary. So this is actually coming back to a risk that Lonsec is really, really focused on, is that it's, okay, be very clear about this. This is not our base case. Our base case is that the RBA is going to keep rates flat, right? So we see them keeping rates flat. But what if you actually get into a scenario where you have an overheating economy, because there's all this stimulus, there's all these people moving in, all these people chasing goods and services, and they're all flush because we all got a job, that you actually have a overheating economy, and then the RBA has to raise interest rates aggressively, right? Then you go back to housing. We are amongst the most indebted nations in the world in terms of per capita household income. We are not collectively in a great position to deal with more interest rate rises. But what if we actually did face some very aggressive interest rate increases, like what we saw back in the 1980s, when the Reserve Bank raised interest rates very aggressively? Then you could see a problem. So that's when, going back to your point, how do people deal with all this? Well, so far, so good. The pressures have been slow. They've been able to manage their finances. But again, this is not our base case. Is there a scenario, which we think that there is a black swan event, where you could see interest rates move higher? Yeah, very low probability, but it is something that we think about and keep in the back of our mind.
I mean, like to what you said, for me, it's only just adding fuel to the fire, really. And ultimately, something has to give. Because it can't just keep going the way it's going. It's it is going to start to impact either the house prices potentially, or your delinquencies will go up.
Impact house prices, impact consumption. I think the immediate release valve is that you're going to see it in retail sales first, right? You're going to see it there. Like even the upper cohorts are going to feel, hey, I've got all the debt, but I've got all the assets, but you know what? That equation's starting to go upside down on me because rates are going higher. I got to start making cuts somewhere else. Or they're realizing, hey, actually, this whole structure is upside down now. I got to start selling property, right? So again, I'm not trying to be alarmist. That's not what I'm trying to say here. And I'm talking about a real sort of black swan scenario. But again, this ties back into how I started this whole conversation. We are late cycle. It is not the time to being aggressive in your decision making. It's okay to be a little conservative right now.
I'm wondering too with that, investment in more housing, but that's been coming up in the media, et cetera, for a long time. What kind of data are we seeing on that?
Well, we do know that the construction industry is still, housing starts are still
quite
muted. I would say they're muted. They're not as strong simply because the rate environment has stopped people from trading houses, right? It's expensive, right? To buy a house. We have structurally underbuilt for a long time, right? And that has been a problem. It's classic supply and demand. If you want to solve a housing crisis, well, just build more houses, right? That's a very flippant thing to say, but it's actually quite complex. You got to build infrastructure. You got to do it in a sustainable way. It's a very complex issue. And so instead of trying to point fingers at anybody, I can just observe the problem. The problem is very simple. It's supply. It's a supply problem. So if we collectively put our heads together and thought about how do we deal with the supply issue, and the supply issue is multifaceted, right? It's about trying to make sure that there's good infrastructure to places where there is available land. It's about making sure that once you got the infrastructure in place, that it is well maintained, right? So that people forget that there's an ongoing running cost. Then you got to build quality housing. Then you got to build housing that people want, right? Maybe not everybody these days wants a quarter-acre block. Maybe some people are very happy to be living closer to amenities and taking a smaller place because the house is not their primary focus of their life anymore. They want experiences. Well, that costs money. So either you want the 4-bedroom house or you're going to move into a 2-bedroom apartment because that suits your lifestyle. I'm not passing judgment. People all make their own choices. But again, it's about choices. You had a comment on, so I didn't really understand this one, and maybe you've touched on it before. Portfolios are being repositioned away from risk control and in favor of market exposure. Yeah. I didn't really understand that one. Are you able to unpack that and what it means? That ties into a portfolio construction philosophy that we have at Lonsec. So we kind of look at your portfolio as having 3 buckets, right? What we call defensive, market, or alpha. Right. And the idea here is that the defensive allocation is, as it says, it is meant to sort of be a shock absorber in your portfolio. Your market exposure, your beta exposure is just like, well, we're trying to do 1-for-1, whatever the underlying index is, whether it's a bond index or an equity index. If you buy, say, an ETF or an exchange traded fund that matches that index, that gives you that exposure, right? So you're not going to outperform, but you're not going to underperform because you're matching, right? Okay. And then, of course, the last bucket is your alpha generator. So this is where we're looking for managers that are trying to beat the index, and they're trying on an after fee basis, right? And so when we put that together, those 3 buckets, that's how we put a portfolio. What was happening for a long time was that because we were late cycle, because we were concerned that the risk of a hard landing was still very real up until very recently, we had a tilt towards risk control in our portfolios. We've now got rid of that and moved back to market, right? So we're not enthusiastic. We're basically, the way I would describe it, back to a neutral position on our SAA. We're not prepared to go aggressive into our SAA. So I think we were talking earlier about ranges. We're in a neutral setting. We're broadly neutral. Whereas previously we were probably underweight in our risk assets. We're now neutral. We're not ready to go overweight on our risk assets.
When you say SAA, I'm going to get Dean no, that's okay. Dean to talk, what does SAA mean? What is Nathan talking about? You talk to clients all the time. What the heck is this SAA?
And that's a strategic asset allocation, where basically how aggressive the funds invested, whether they're more on the growth side of things or more on the defensive side of things. So basically, depending on the client stage within their life stage and how comfortable they are within their asset allocation will depend on where they sit, whether they're going to be skewed more towards the growth type of investments or whether they're going to be a little bit on the safer side, more on the defensive side.
That's right.
That's why I was going to a financial advisor. What the heck does this jargon mean? Would you consider, because a lot of our clients, correct me if I'm wrong, Ray, they are very interested in investing in direct real property. Is that more of an alpha type of move in the context of your portfolio structure? Is that considered an alpha investment? Well, or not really? It just depends on how much.
Within your portfolio, property makes up part of your portfolio. So you have to look at your wealth in totality.
Okay.
Right? And so whether you have shares, whether you have bonds, whether you have cash, whether you have property, it all goes into the mix, right? So it is not alpha per se.
Okay.
It is just one of many asset classes that you will have. Within our taxonomy, what we're talking about is that when you get that exposure to that asset class, are you trying to be sort of defensive, neutral to it, or aggressive to it? That's kind of the way you should be thinking about it. And so buying property isn't in of itself a aggressive move. It's about just making sure that you've got a well-diversified portfolio.
How do you talk with clients about that concept, Ray? Because we love our property in Australia. How do you pick that up when you're talking to clients?
I think the key concept that we talk about with the clients is always about the diversification side. Okay. If you've got a couple of different assets, you've got an actual property there. What does it look like from the other side of the mix for yourself? Because you don't want to be one side, property side heavy, and the other side you have sort of left yourself a little bit of a gap. So we do talk about the overall diversification of an asset pool or their combined assets, as opposed to just being property heavy. I still got this burning question in the back of my mind, which I didn't get to sort of
Get it out.
Nathan, which camp are you in? So do you reckon that interest rates are going to stay where they are for a longer term?
Yeah, absolutely. Yeah. We were very much of the view that the RBA has got very little defense or any support at this point in time to start reducing rates. Right. We think rates are our base case right now is it's flat.
Right, okay.
Right? We think that rates are flat. But we can see a scenario where rates could actually go up. Right. So the risk on our side isn't down, but up.
Up, okay.
Right? And so that's why we are conservative, but it's in, again, the context of a very strong economy where the Reserve Bank, using their very blunt tools, they only have one handbrake to slow things down, to prevent an overheating economy. They pull that, which is unfortunately interest rates, which is just going to have a cascading effect on the economy, right? So this is why people always talk about how monetary policy is such a blunt tool to manage the economy. So again, it is our view that rates are flat, but with upside risk.
I think for me as a summary, hearing this again as a layperson, it's really important it's good to get that perspective. And then obviously as advisors, speaking to clients with that perspective and that knowledge, it's actually preparing clients, making sure that's part of the conversation relative to their needs and goals, right?
And cash flow.
And cash flow.
All of it. If you're projecting for that amount of period of time, you go, well, like you're going to sort of put a bit of a risk into their portfolio to go, well, what does that look like? And what does that look like from the cash flow perspective, mortgage perspective, bit of if not, you increase the risk by 1 or 2%, you dial it up a little bit.
I can see that interplay. You were going to say something, I think.
Well, I was just going to say the last point I make about it as
Yeah.
well is that rising interest rates aren't bad for everybody.
I was
Right.
because I know because and I again not going to tell my age. I'm a bit more mature age. So for me, if I have interest rates going up, I can lock in certain things and take advantage of it because of the nature of where I am
Yeah.
in my life stage.
Exactly.
Right?
And this is why, again,
Because I've got no mortgage, thankfully.
Exactly.
I've seen a good financial advisor, so
that's
that's
right. You
why.
bring it full circle, right?
Yes.
It's just that
Yes.
you have to know your circumstances,
Yes.
and you are the classic example of somebody who has put themselves in a position where they're financially liberated because
Yep.
you don't have debt.
Yep.
And rising interest rates means that from your pool of assets, you get a better return. This is
I
great.
know. I'm going
This is
like
fantastic,
this.
right? So, but to triangulate all that again is the importance of having
Yeah.
a great financial advisor.
It is, because I have 3 daughters and all of them are trying to get into the property market. So we really need, and I have taken advantage of really good financial advice. I look at it from a family point of view because
Yeah.
they're in a different situation and interest rates going up is not a great thing for them.
Yeah.
So I
And
need that
advice that's great for you is not necessarily appropriate for
Yeah.
them
Yeah.
and vice versa.
Exactly.
And sometimes this is where the financial planning from a family
Totally.
perspective comes into play. Yep.
It is for me. And I mean, obviously I've been in the business for a while, but definitely I see that happening, kind of what was our earlier conversation as well.
You know,
Really
how do
need-
you sort of shift assets
Yeah,
around
because
a
I
certain
want to
way?
help them, but
Yep.
also helping them, I need to help myself as well.
Exactly.
So really good advice backed by a lot of this data and all this support is very, very important.
Wonderful.
Gentlemen, thank you very much. I hope this has been very insightful. I hope everybody's enjoyed our podcast. And thank you again, Nathan Lim from Lonsec, Chief Investment Officer. Chief, really appreciated all of your insights. Thank you very much, Nathan.
Thanks for having me on the show.
Thanks, Tara.